My name is Howard Coleman, and I am the Chief Investment Officer of Coldstream. With me today is David Powers. David is a portfolio manager and a member of the ISG team. He does hold the Chartered Financial Analyst designation. David will be giving the market update. As those of you who have attended the call before know, we also try to address a topical issue in each call, and this quarter I will be discussing the implication of a potential Fed rate hike. You are in listen-only mode, and as you know, for the first time we are using a WebEx format, which will enable you to type in questions. We will leave some time at the end of the session for questions, but may not be able to get to all of your questions. If your question is not answered, please feel free to contact your relationship manager or your portfolio manager with your questions, and they will answer them. I will now turn the call over to David for the market update.
Okay, in terms of the final numbers, the second quarter was relatively benign for most of the equity asset classes. However, the way they got there was hardly tame, as events in Greece, Puerto Rico, and China all converged to wreak havoc on risk assets at the end of the quarter. We'll touch on each of those events a little bit later, but first let's take a look at the performance snapshot of the broader asset classes. The more diversified U.S. large cap indices, such as the S&P 500 and Dow, are relatively flat and really haven't been able to get off the ground for most of the year. The one highlight has been the tech-heavy NASDAQ, which has been aided by the continued strength in the biotech sector. Mid and small cap stocks paused in the second quarter, but are one of the equity leaders in the first half, and the same could be said here for international stocks. The good news is that outside of emerging markets, most of these equity classes have enjoyed a nice pop to start the third quarter as some of the headline risk is washed away. Howard will get more into interest rates in his portion of the call, but fixed income as a whole dipped as rates trended higher. The upward trend has also impacted REITs, which just had an awful second quarter, down that 9.06%, and is down 5.44 for the year. Commodities showed some life in the second quarter as oil bounced off its lows, but overall remained in the red for the year. We wouldn't get too excited about the bump, considering the index has dropped another 6% to start the third quarter. So that's a pretty significant down, roughly almost 12%. We have some charts later that show how, why we remain down on both REITs and commodities. But before we do that, let's take a closer look at some of the broader indices. Basically, this is just a snapshot of the S&P 500 going back to roughly the beginning of the year. We remain constructive on large cap equities going forward, but we have to admit this chart isn't all that appealing. The nice trend that we saw here at the beginning of the year just kind of rolled over here in May and has continued to do so, followed with this free fall that you saw at the end of the quarter, which is unfortunate for statements. But the good news is that once July kicked in, we were able to get back up to our highs. Going forward, though, with market internals trending negative, earnings coming in relatively mixed, and the headline hangover still prevalent, we wouldn't be surprised if we stayed in this tight trading range for the foreseeable future. Small cap stocks, basically this takes a look at the Russell 2000 over roughly the same period of time. They were enjoying a really nice breakout for most of the year, especially here through the May period of time, but were definitely derailed by the Greece, Puerto Rico, China storm that occurred. They have not been able to regain most of their get back to their highs. Despite the elevated valuations in this asset class, we do believe that the strong dollar trend will be a tailwind. It's an area that we are focused on going forward. For a relatively benign quarter, it actually was very active if we take a look at in between sectors, and I apologize, some of this reading may be a little bit small, but there were definitely some haves and have-nots. As we mentioned before, despite the bounce in oil, energy stocks were by far the worst sector. Rate-sensitive REIT and utility stocks were also off. Thought here is that traditional fixed income becomes more attractive as rates rise. These risky or bond substitutes are less in demand. As I mentioned before, biotech continued to run hot, and that you can see that there, roughly up about 5%. But the clear winner was in the banking sector, up 8.9, 7.1 there. 8.9 on the regional side, 7.1 if you take the whole banking into consideration. Fairly impressive run that we've seen here since July in the banking stocks, and this is basically on the thought of higher interest rates. Will certainly benefit lending. those who lend, I should say. Moving on to the international side, this is basically just an ETF of basically the, all country except the U.S. It represents about 85% developed nations and about 15% emerging markets. They were off to a terrific start the year, obviously, with the events in Greece and China that you can expect that they would be hit a little bit worse. Have had a nice recovery, but just haven't really gotten back to the highs. It is an area that we are relatively constructive on going forward. We've got a couple charts to show why. We showed this chart last quarter, and basically this is just a relative value chart and just kind of overlays U.S. stocks measured by the S&P 500, international stocks measured by EFA. It's a backward-looking chart, but you can see the average here in the black line and one standard deviation, the dotted line, two standard deviations on the solid gold line. And basically the relationship holds pretty good, is that as we get closer to the two standard deviations, regardless of the direction, we see a meaningful trend. Now those trends can have up and downs, and there's some volatility in there, especially you kind of see in this particular area that I'm pointing to. But point being is we are now at another inflection point here where we're at another double standard deviation, two standard deviation move. And so going forward from a relative value trade, we think that this could be kind of a long play for international stocks. The other benefit here, the chart we're looking at now, is assets on central bank balance sheets. We don't, very cautious about buying into don't fight the Fed mentality. It doesn't always work. I think if you go back to 2000 and you go back to 2007, 2008, the Fed was, easing quite rapidly to stem off recession, and the market still went down roughly 50% over those periods of time. So it's not a foolproof plan, but if we did overlay an S&P chart to what's going on here in the Fed balance sheet, you would definitely see a very high correlation. So if that holds true down in this particular area where the ECB and the Bank of Japan now have a lot of room to grow their assets as the Fed and the Bank of England have kind of leveled off, you would anticipate that barring any exogenous events or any more headline risk, which seems to be in the past at this particular moment, we could anticipate that international stocks would continue to do well. Obviously Europe and the Bank of Japan make up a great deal of what goes on in the international sector. Be foolish to talk about international environment without touching on China. It obviously wreaked a lot of havoc on the markets towards the end of the quarter. You could see just this magnitude. This is 150, basically 150% run from July all the way up for basically 1 year. This down move is roughly 30%, so obviously a significant decline, but obviously there's still a lot of built-in gains over the last year. And to put it into context, I know the market, certainly reacted poorly to this, I think, globally, but if you take a look at and kind of put this into context of other, if we're calling this a bubble, other bubbles that we've had in the past, going all the way back to 1982, you can see the Nikkei bubble, which represents Japanese stocks, the subsequent decline, the NASDAQ back in 2000, and the magnitude there, and that decline. China's already actually had one. This even pales in comparison to their own recent one. Oil in 2008. This one's interesting, and we mentioned biotech. It's still running hot. This is still as of a year-to-date basis. So this is certainly a pause for concern, definitely for those invested in the NASDAQ and some of the smaller cap names out there. This is a concern, and we're paying close attention to it. If this were to start to roll over and we were to see one of the precipitous drops that usually happen in this area, I think that's probably a bigger concern than some of the transitory things happening in Greece and Puerto Rico at this particular moment. To stay on the hot topics and what has kind of occurred over the quarter and brought the markets to a little bit of a halt and a downward swing, certainly Puerto Rico potentially defaulting on their debt, and on the surface not that big a deal, but again we always try to figure out, well, what's the ripple effects and how this is going to affect the overall municipal bond market. Basically what you're looking at here is the Strategas 15-city index spread. This is in red versus treasuries, and is represented on the right-hand side, and then you can see the Puerto Rico 20-year debt, again with treasuries, and this is representing the left-hand side. I'm sorry, I have to reverse that. This is on the right-hand side. Left-hand side is the muni index. Point being is that the dotted line for the Puerto Rico has definitely blown out significantly. That would be expected. But the contagion to the other municipal cities hasn't really been that bad. Obviously areas such as Illinois, Michigan, maybe even Connecticut may be affected a little bit. But for the most part, this has stayed relatively, the move hasn't been significant. So we're comfortable going forward that even if there were bigger issues, that the muni market would be able to absorb that. The other big issue, obviously probably the most that's been talked about, is what's going on in Greece. Frankly, we probably think this is the most transitory and least impact. Greece, in terms of what it represents of the European economy, is relatively small. I think it's got the economic GDP of the state of Missouri. So there's really not, we don't anticipate from a fundamental standpoint this having a big impact. But obviously there's contagion, and there's, what's the ripple effects, and what will happen with Spain and Italy if those are the case. But let's just say that, it's obviously out of the headlines for the particular time being, which is great news, and obviously markets have recovered. But let's just look at it. Well, what would happen if we actually did a year from now, or a couple of years from now, when this all comes back again after, Greece has obviously taken some more austerity measures for further relief. But let's just say it all goes bad. What's kind of the impact? And what this chart really looks at is just what the other country exposure, Eurozone exposure, is to Greek debt, and what percent of that is of GDP. And you can see Germany and France are obviously the biggest, the biggest proponents here, components here. But from a standpoint of what it is of their GDP, it's relatively small. So even if it all goes bad at the end of the day, we feel from a, just a fundamental standpoint and on paper, this would not have a big effect, and the contagion should be relatively limited. So I think we are just limited to some headline risk here going forward. Before I turn it over to Howard to discuss the interest rate environment and then the potential impact of that, I do want to touch, I did promise to touch on a couple sectors that we are a little bit concerned about going forward. This takes a look, this is basically a look at commodities. We're just going to use oil as an example, but considering the tepid global growth that we have, especially in the emerging markets, we anticipate that commodities as a whole just won't have the demand to be strong going forward. But this takes a look basically at U.S. oil production, and you can see that despite the drop, we showed this last time, but we'll show it again because it hasn't really changed all that much, which is a little bit of a surprise, is that rig count has come down quite a bit here, and this is in the solid blue line, and you can see production has stayed relatively stubbornly steady up high. And we, while we expect there to be a lag, and we do expect this to come down a little bit, considering the efficiencies that we think we have in U.S. oil production, we would anticipate that this would stay relatively high. Throw on the fact that OPEC has also stayed pretty steady, that they're going to keep their production at these levels. We just don't think the global demand will be able to offset this. So that all said, we expect energy prices to remain relatively low, and on top of that, other commodity prices not to do particularly well here in the near term, probably over the next 12 months or so. Finally, we'll take a look at kind of what's going, REITs we mentioned, we're a little bit down on REITs, certainly has played out for us as we've underweighted that area. And, you could see here, basically taking a look at, the gray line is U.S. multifamily, the green line is U.S. all, commercial property, and then you have residential markets down in the blue line. You could see from a multifamily and a consumer property level, we're actually above what we were in, kind of that bubble period of 2007, 2006, 2007, before went a little south in 2008. So outside of residential property, this is on a, this is on a country base. Obviously, there's some hot pockets in there, Seattle being one of them. You can see that they're, we're well above the tops there, and that has really put us, give us some caution on what we're doing and anything, kind of associated with real estate. So those are my comments. Obviously feel free to ask questions, and we'll do the best that we can to answer them. But I will now turn it over to Howard to discuss the current interest rate environment.
Thank you, David. This portion of the call will assess the factors facing the Fed in deciding when to start the housing cycle, but more importantly, how quickly to continue tightening after the first rate hike, and by how much they should tighten. Before we start, I want to talk about a backdrop of two important factors. The first is I want to remind you of what the Fed mandate is. The Fed mandate is twofold. It's inflation and it's full employment. And the Fed has maintained a 2% inflation target. Keep that in mind as we're talking. The second is the two competing theories that the Fed is facing. The first is that zero interest rates, we must remember, are emergency measures. So by indicating that we are in a zero interest rate environment, the Fed is saying that the economy is still in an emergency state. But on the other hand, on every Fed member's mind is what is referred to as the mistake of 37. And that refers to 1937, when we were coming out of the Depression, when the Fed tightened too quickly and too much and caused the economy to tumble back into a depression. Now, of course, as bad as the Great Recession was, it doesn't compare to the 30s depression in magnitude, but still, it's a cautionary it's a cautionary tale, and one that our former Fed chairman, Ben Bernanke, was extremely cautious of. So those are the two competing poles that the Fed has currently. Now, Janet Yellen has recently indicated really a very strong desire to begin raising rates in September. And absent negative economic data, there's a high probability she will. But we think that the pace afterwards will most probably be pretty slow. The pace itself will be governed by what we consider to be 4 overriding factors, and I will discuss those factors going forward. But before I do, I would like to talk a little bit about the market expectations of the Fed and what are the competing considerations for the first rate hike. So we'll talk first about the first rate hike, when we see that happening, and then we'll talk about the continuation of rate hikes and by how much. So the first chart here shows what the futures market, what the market is expecting, versus what the Fed, through their dot plots, have indicated that they would like to have happen in terms of rate hikes, and then primary dealers, who are the large, really the large banks and the large investment banks primarily. As we can see, the futures market is anticipating a much slower pace of rate hikes over a more extended period of time than the Fed itself is. The Fed itself is the green line, but everyone right now is indicating that there will be a rate hike at least by December. This 0.32% on the futures market is a change from earlier in the year. In the middle of the Greece crisis, actually, it went out again to March of 2016, but the market is now expecting a rate hike sometime in December. The Fed's indications are that it will happen in September. So what are the competing considerations? As I mentioned before, you have inflation and you have full employment. So let's first look at inflation. There's lots of different ways to measure inflation, but the Fed's favorite measure of inflation is the personal consumption expenditure, the PCE. And the PCE here has been stubbornly below its 2% target. As you can see, the latest core inflation right now is at 1.24%, and the latest headline inflation is only at 0.22%. This is really, as David pointed out, commodity and energy focused. So by this indication alone, the Fed should not be raising, or would not raise. And this is just a reemphasis of David's point that he made earlier. This is the continuous commodity index. It's an ETF of commodities. And you can see how significantly it's fallen. And low commodity prices cause, of course, low inputs and are not inflationary. They're counter-inflationary and could also be considered deflationary. So if the Fed raises too quickly and too fast, it does create a problem about the low level of inflation that currently exists. Now, on the other hand, employment has been doing extremely well. This chart, the employment rate currently is about 5.3%. This just shows a year-over-year change in the unemployment rate. And we can see since 2011, it has continued to fall, right? It falls about between 0.5% and 1.5% pretty steadily since 2015, and we are really approaching the level where the Fed views this to be full employment. As I mentioned earlier, there are also other indications of inflation beyond the Fed's preferred measure of, as we discussed earlier. But here is another measure, and this is wage growth and the employment cost index, and we can see that actually wage growth is actually picking up. So we have a kind of competing narrative here with some inflation measures on the one hand and some employment measures on the other, which indicate that the Fed would actually want to raise. As I said, it's our view that the Fed thinks that the emergency is over. They would like to raise, but they are concerned, as I mentioned, about raising too fast and doing what, for example, Sweden and South Korea recently did, which was raise but have to retract those raises. The Fed does not want to be in this position. So what are the things that we're looking at to measure once they raise, which we think will happen in September and December? What will they be looking at to see, do they need to change course? And the first is the yield curve. The yield curve measures the rates for different Treasury instruments from 3 months to 30 years. And as you can see, since last year, the yield curve is flattened. And it is flattened because the long end has come down a little bit and the short end has come up. The short end has come up as a response to anticipated rate hikes. As you well may know, that the Fed only really directly controls the shortest end of the curve. They set the overnight rate that banks get on the reserves that they lend to other banks. That's really all it is. And the 3-month and the 1-year rate pretty much reliably play off of that rate. It's going to be slightly higher than the overnight rate because of really the time value of money. When you get out on the curve, a whole other series of factors come into play as to how high or how low those rates will be. And those concerns include, those issues include whether inflation is seen on the horizon, what people think the growth rate would be going forward. Now, the Fed probably wouldn't, so there's obviously 3 options. The yield curve can steepen, the longer end can go up higher than the shorter end. The yield curve can flatten, or you can have a parallel shift. In other words, it all goes up at once. For the economy, it's our belief that the Fed would be fine with a parallel shift. They would be fine with a slight steepening, or they would be fine with a slight flattening. However, they have to be concerned if flattening occurs too much or if there's an inverted yield curve. In other words, let's say the 2-year or the 5-year rate is higher than the 10 or 30-year rate. That's an indication the economy will slow, and it's the most reliable predictor of any that we know of a recession. So if the Fed moves too aggressively and the market perceives it as moving too aggressively, the long end of the curve could fall, invert the yield curve, and that would be disastrous. On the other hand, if the Fed is too passive and the yield curve steepens too much because people see inflation coming down the pike or they see growth really strengthening, the yield curve could significantly steepen. And the concern with that is that if the 10-year raises too quickly too high, mortgage rates play off of the 10-year. And if mortgage rates shoot too high, you could thwart the housing recovery, which would be something the Fed does not want to do. So they're okay with modest movements in the yield curve, I believe, but extreme movements are what they have to be very cautious of. So that would be the first sign that the Fed is looking at. The second sign, and there's a related sign, is the housing market. What's the change going to do to the housing market? And that's related to the long end of the curve. As David mentioned, as we all know, housing prices have not really reached 2007 peak, although some markets like Seattle are approaching frothiness. New home sales have dramatically declined and have been nowhere near where they were pre-crisis. The Fed would like this to change. Now, existing home sales and home prices have moved up nicely, but the new single housing market has not recovered, and the Fed would like this to recover. So they're going to be careful in terms of raising, not to cause this to go down further. The good news is on keeping the 10-year in line and not having it rise too much, and why we're fairly confident that this won't happen in the rate hike, is where rates stand in the rest of the world. Even though our 10-year is at a historically relatively low rates of 2.37% for the 10-year, when you compare it to the German Bund at 0.76 or the Japanese, excuse me, the Japanese 10-year, it's much, much higher. And you have fund flows, and fund flows seek returns. And if the 10-year starts to rise, more money will pour into the 10-year from the Bund or the Japanese 10-year, and will keep
the U.S. 10-year in line. And as you can see for this year, there's been a very strong correlation between when the bund moves up versus when the U.S. 10-year moves up. And currently, low rates internationally will help keep a lid on the 10-year rate for the U.S. in our view. The next and probably the most critical concern for the Fed is the dollar. Dollar strengthening by too much will really hurt U.S. companies doing business overseas and will create difficulties for any of our exporters. So this is what the Fed will have an eye on, and if the dollar strengthens, the Fed will be very, very slow to move anymore because increased interest rates will result in dollar strengthening because people will want to invest in the dollar because they're going to earn more interest than they would, for example, in the yen or the euro where they're going to earn less, the carry trade. And so the Fed will keep an eye on this because the dollar should be impacted by Fed rate hikes, and they're going to want to minimize that. The final point I want to make in terms of what will govern Fed rate hikes is David showed you this chart. This is a little more of comparative balance sheets. This is the Fed balance sheet. And this is the total assets on the Fed balance sheet. And assets on the Fed balance sheet, 1.5 trillion of these assets are going to mature within 5 years. What the Fed is currently buying as treasuries as treasuries roll off, or buying mortgage-backed securities as mortgage-backed securities roll off. This keeps a lid on rates. The question is, will the Fed continue to do that, or will they want to, they clearly want to shrink their balance sheet. Will they let them roll off and not rebuy, or will they continue to rebuy? And this is the other way the Fed can govern rates other than actually the Fed funds rate. Because if they sell treasuries, by the law of supply and demand, that will keep a lid on their prices. So the balance sheet and how the Fed uses that balance sheet will play a large role into how quickly or how slowly they hike rates. In sum, our view is this. The Fed will, we think, absent bad economic data, raise this year, maybe once, maybe twice. The pace will be extremely slow. They'll be looking very closely at what happens at the dollar. They'll look very closely at the yield curve. They'll look very closely at the housing market. And they're going to have to make decisions about how they use the balance sheet versus interest rates to govern the effect of the long-term, what the 10-year and the 30-year do. So that concludes our discussion today. We actually do not have any questions. Thank you very much for your attendance. And if you do have any questions, feel free to contact your portfolio manager or your relationship manager for any further commentary. Thank you, and we'll talk to you next quarter.